My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you a little money. My job is not just to entertain, but to educate. Put everything like today in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Enough hasn't been enough. There's been fear, but not enough fear. There's been capitulation, but not enough capitulation. And that's the story of this market. We just had another horrible day where we thought we'd seen the last of the extreme losses. Dow tumbling 431 points. S&P plunging 1.37%. NASDAQ plummeting 1.87%. Yeah, they got to the NAS. But what you may not realize is that the bond market is the same thing going on in stocks, which is unfortunate because the bond market's a lot more important than the stock market, a lot bigger, and it is leading us by the nose. It's just that unless you're a professional investor, maybe you don't realize it. So tonight we got to get an understanding about the tyranny of the bonds, how they are the overlords of stocks, whether we like it or not, and I don't like it. Yep, when the bond market sneezes, stocks get pneumonia. And man, is the bond market sneezing this darn fool head off. They are selling everything in the bond market to get out before, well, at this point, maybe it's just their shadows. We don't even know anymore. Right now, there are four kinds of very motivated bond sellers. There's the Treasury Department, which needs to finance our government's massive deficits. There's the Federal Reserve, which has $5.3 trillion in treasuries in its coffers, another $2.6 trillion in agency mortgage-backed securities. Crazy town. It sells them as a way to shrink the money supply. It's supposed to not be selling the long ones anymore, but they're selling. There are the regular owners of bonds, some of whom borrow gigantic amounts of money to own those bonds. And then finally, there are the short sellers who are trying their best to slam the price of bonds down. And they have been the winners. And you got to hand it to them. They got this right. They can probably keep winning if the Fed raises rates again. And long rates, the 10, 20, and 30-year treasuries don't yield more than the Fed funds, as they most certainly will if this keeps up. Yes, these days it feels like the bond prices go down on anything, any positive news about the economy. Today we got positive job openings numbers from August, so bond prices plummeted, so yields soared. What else is new? Yesterday we had stronger than expected manufacturing number, rates soared. The benchmark U.S. 10-year has gone from under 4.6% to around 4.8% in just 2 days. Many are now betting that Friday's employment number will show meaningful job growth, which will bring even more selling. Sell. And you know what? It's perfectly reasonable for longer-term bonds to go down in price and up in yield. For almost my entire career, longer-term bonds had a higher yield than short-term ones to compensate for all the risks that can emerge over time. Only in this crazy period have long rates been so much lower than short rates set by the Fed. That's now changing. It's something I've been worrying about for almost the entire year, particularly in April when that 20 was like 3 3/4. It's now at 5 and change. We're witnessing a wholesale reordering of the bond market. The 10-year, 20-year, and 30-year are, I think, all headed to higher rates than the federal funds rate, which is currently at a range of between 5.25 and 5.5. And longer-term bond yields will keep rising if the Fed keeps tightening. Now, I don't like talking about bonds because bonds are usually very boring, but there is nothing boring about this bond market. Treasuries are trading almost like small-cap stocks. That's how I want you to think of them. Think of them like stocks. The owners either can't take the pain,
the house of pain,
or they've got to put up more money to meet the margin calls because of the losses, and they can't. As long as you understand that bonds can plummet just like stocks, that there are short sellers and vulnerable people who buy on margin just like stocks, then maybe you can get your head around the velocity of this move, which is just stunning. I got to tell you, this bond market meltdown is like nothing I can recall in a first world country. Which brings me to the impact on stocks. Right now, as rates go higher, investors are deciding that stocks can't be worth nearly as much as they thought they were. Case in point, something you know in your pantry. Yes, McCormick, the spice company. Today it reported what I thought was an okay quarter, with management talking about great strengths in many categories and raising its forecast. If not for China, McCormick, the spice company, results would have been incredibly robust, and they think China will eventually turn. In a different environment, you know what? I think McCormick stock would have soared today. Yeah. But thanks to this relentless tsunami of selling, it ended up plummeting nearly 8.5%. That's the bond market spilling over to what I'm looking at right here. We like McCormick for its consistent mid-single-digit growth and for its popular brands. The company's been a great acquirer of hot sauces and mustard, all sorts of things that you can use to cook at home. Something we learned during the pandemic is pretty good and cheaper. But with rates going nuts, money managers won't give something like McCormick any credit for consistent single-digit growth, not when the stock sells for 25 times earnings. Remember, when rates go higher, Wall Street collectively pays less for future earnings, as demonstrated and is viewed upon by that multiple of 25. It should be smaller, and that means the stock needs to go lower. So instead of rewarding McCormick for its consistent middling growth, we slaughter it because it's not growing fast enough to justify its valuation in this environment. Whatever used to award McCormick for its bland positive qualities has been washed away thanks to the action in the bonds. Yes, what I'm saying is we're going to pay less for French's as described by the multiple, the price-to-earnings multiple. That's what you have to think about. I know this is a hard concept to understand. I always go back to my first days at Goldman Sachs when I was quizzed in front of a bunch of people, classroom style, about what I thought of the stock of Delta Airlines. Oh, back then I had almost photographic memory for the facts and figures of individual stocks. I knew precisely where the stock was. I knew how well it was doing, and I knew how well the airline cohort was doing. I was able to factor in loads, how many people were flying, even knew the revenue per seat mile and the price of jet fuel. Only after all that did I come up with a price target that was about 20% above where it was trading. Whew. Did I think I was smart? I thought I dazzled. Then the instructor asked me, where's the long bond? I didn't even know what the long bond was. You know, the bellwether bond. Thanks for that hint, he probed, sensing that my silence had me on my heels. Then he asked, and where's it going? I raised my eyebrows, opened my mouth. Nothing came out. He told me to leave the classroom. What was the point of all that gibberish I just spat about Delta if I didn't include the action in bonds? He said the bond market determined the future, and you need to shoehorn the facts into that bond worldview. I thought he was kidding. I didn't get up. He said, I told you to get out. I got out. Oh, man, I was petrified. Was I going to be fired? Was I that stupid? Eventually, the class let out. All my classmates filed past me without even looking at me. I was sweating like a husky in the heat. And then the instructor walked out. He turned to me on the way out, and he said, the long bond's the 30-year treasury. He told me what it yielded. He told me where it was in price. He told me it was going up in price and down in yield. And in that situation, there were better stocks to own than Delta. Then he told me to go home. I asked for good? No, he said just for today. And maybe show a little humility going forward, given how little you actually know about what impacts stocks. I never forgot that terrifying moment. It makes my job actually easier in days like today. I got pants because I didn't know that bonds were much more important than stocks. And the direction was much more important than anything else, including earnings per share, fuel, revenue per seat mile, and the sector. And bonds were doing crazy stuff then like they are now. Most investors haven't paid attention to bonds in ages because rates were steady to lower. That's over. Right now, we're all in that Goldman Sachs classroom where I was so smart that I made a fool of myself. McCormick, it's Delta 40 years ago. As for me, that was arguably the most important lesson I ever learned. Bottom line, until rates go down, meaning until bond prices go up in price, this cascade is going to continue. Do I think it's overdone? Yes, absolutely. We bought stocks today for the Charitable Trust because they crushed the NASDAQ, and our provision is always that we buy stocks on these big, bad days. But if rates keep rising, we'll lose money on those stocks because bonds are in charge for now, and they aren't allowing stocks to rally. They're only allowing them to fall. Bill in Massachusetts. Bill.
Booyah, Mr. Cramer. Booyah.
Booyah, Bill. What's happening?
Hey, I got a question on you. What do you think about picking up a little MongoDB?
Okay, I think MongoDB is an amazing company. It reported a fantastic quarter. Right now, with interest rates going high so quickly, people don't want to own MongoDB. But you know what? I actually think of the quarters that we had of the enterprise software, you got the best one. So what? I would put on a little bit, not a lot, because that is the kind of stock that's going down. But boy, if things turn with the bond market, that stock's up 50 straight points. So I like your gumption. Chris in Washington. Chris.
Hey, Jim. How are you?
Well, Chris, after a tough day like today, I got to rethink a lot of things. How you doing?
About the same.
Okay. Yeah, I hear you.
Appreciate being on the show, and thanks for everything you do for us home gamers.
Oh, you're true. You're true for saying that.
Yeah, no, thank you very much. I heard what you said about Kimberly-Clark and the consumers not trading down on certain products this morning. Does that thesis carry over to retail store profits? And what do you think about Kroger?
All right, so that thesis does spill over, as you're right. And Kroger is doing what I think is a very good merger with Albertsons. The problem is that deal is being reviewed by Lena Khan at the FTC. And as much as Kroger's doing everything to make it so that it would work, I think Lena Khan, unless she finally gets a little pro-capitalist attitude, is going to try to block it because that's her nature. Her dogmatic nature bodes poorly for Kroger, even though the merger would be a good one for Kroger, for even the employees, and it'll be one of the largest union companies in the country. Right now, the bond market is in charge of stocks. And until the moving rate starts to stabilize, this cascade of selling will continue. Is it overdone? Absolutely. But what does that mean these days? Mad Money tonight. Macy's announced today the company's doubling down on smaller format stores in a move that gets the iconic retailer less dependent on the mall. I'm learning more about this new plan with the company's incoming and outgoing CEOs. Then, with an economy like this one, the Federal Reserve is watching the labor market like a hawk. So I'm watching like a hawk by going to Paychecks. Yes, I'm learning about what they're doing and how they see the small, medium-sized businesses and how they're faring and what we can do before the Fed makes any action. And after reporting a strong quarter in August and giving up most of its post-earnings gains, are investors getting a buying opportunity in the specialty vehicle maker that is Oshkosh? I'm getting the latest from the CEO and checking out its latest innovation from the front of the New York Stock Exchange. You don't want to miss that. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.